I cannot explain why you love me so, Jesus, Jesus. I cannot explain why you love me so, Jesus. We live, okay. Uh, 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 mm, mm. All right, so good evening, good morning, wherever you are from. Thanks for joining us on the stream today as we continue with our live practice question masterclass on key subjects and key areas of some subjects as we prepare ourselves going into the examination. And today we're going to be looking at financial reporting, corporate reporting, evaluation of financial statement. This is a 20 marks area that is going to be in the exam hall that we need to know about. And so we want to take some time to go through this and then discussed and solve some questions that we need to understand here. If there are any questions you have, you know what to do. Put it in the comment section or the chat because I'm going to be reading them and then providing you with any answers that you may be having. So let me bring up my screen quickly and then we can get excited into the discussion for today. So evaluation of financial statements, 20 marks coming in the exam hall. What are we supposed to do with it? So, evaluation of financial statements. As always, the first question we ask ourselves is what are the options available to the examiner? In other words, what are the styling of questions that the examiner is likely to bring to us when it comes to this key area, evaluation of financial statements? As I say always, it is important you have an understanding of what to expect in the exam hall. Position yourself very well so that when you go to the exam hall, you will not be surprised. There are 6 styling of questions that the examiner can bring when it comes to evaluation of financial statements. Now, those of you studying under my mentorship, you have access to the document already, which is the ratio analysis principle document, but I'm going to just discuss the styling of questions. So, in this area that we're going to be seeing in the exam, or question 5 for corporate reporting students, question 4 for financial reporting students, there are 6 styling of questions that the examiner can bring to us. And knowing the style of question and how to approach it is going to play a key role in our ability to excel in the exam, or especially when it comes to dealing with this area of the examination. The first one is simply to calculate the ratios and analyze the performance of the entity. This styling of question is the easiest. You are not going to be doing anything. You are just presented with financial statement. There are no nuances there. Just a simple statement, financial statement, and you calculate some ratios, profitability ratios, liquidity ratios, efficiency ratios, and probably some investors ratios. Then you interpret. That's the first styling of question. The second styling of question is where the examiner says, listen, hey, I don't want you to do any calculation. All I want you to do is to analyze the performance of the organization. And so in that styling of question, the examiner is going to present you with the ratios in the question. Then all you are required to do is to write out the analysis. That is the second styling of questions when we come to the evaluation of financial statement. The third styling of question is going to be what we call vertical or common size analysis. So each line item is going to be taken as a percentage of total revenue. So instead of you seeing the statement of financial performance, revenue, cost of sales, and seeing figures, this time around you are going to do percentages. In the statement of financial position, usually the total asset will be the base amount. And so each line item will be taken as a percentage of the total asset. That is the idea about vertical or common size analysis. And we may be asked to either prepare and analyze, or the examiner will prepare it for us. Then all we are required to do, or we will be required to do, is to analyze it. So that is the third styling of question that we need to be mindful of. The fourth styling of question is going to be where there is changes in business or changes in operations. What does this mean? This simply means that the entity is going to sell part of the business at the beginning of the year, in which case it means the previous year financial statement may be a consolidated financial statement, and the current year financial statement has to be adjusted, and so it is a single entity financial statement. In that environment, how do we compute the ratios? What are the adjustments we are required to make, and how do we analyze the financial performance and position of the entity? Another styling of the change in business or operations is where there is acquisition. So at the beginning of the year or during the year, the entity acquires another business. Okay, so what is that? What does that mean? It means that the previous year financial statement may be a single entity financial statement, and the current year financial statement may be consolidated financial statement. And so in those styling of questions, how do we calculate the ratios? What adjustments are we required to make? And most importantly, how do we analyze the performance and position of the entity? So that is the fourth styling of question, changes in ownership. The fifth styling of question, finally, for financial reporting student, is the financial statement with additional footnote for adjustments. What does that mean? It means here you are going to be making some adjustments to the financial statement. The difference between the fifth styling of question and the first styling of question is that in the first styling of question, there are no footnotes. You are just calculating ratios with a financial statement given. But the fifth styling of question, there are footnotes, and the footnotes will then require you to make adjustment to the financial statement. Usually, in that styling of question, the adjustment that you will make to the financial statement will be dependent on your understanding of the IFRSs. It means that if you are weak on the accounting standards, you are going to have a problem in your ability to address or answer questions relating to where we have the financial statement and the additional footnotes. And that will also going to feed into the way we are going to be analyzing the financial performance, the liquidity position, the working capital efficiency, as well as if we are supposed to do gearing ratios, how we analyze that. So for financial reporting students, these are the 5 styling of questions. So as you are going into the exam hall, one of these 5 styling of questions will be waiting for you in the exam hall. The only way you can excel in this area, which is question 4, for financial reporting students, is to solve and understand the principles underlining each of these styling of questions. Because each of them, the examiner can decide to bring any of them in the exam hall. Now, for corporate reporting students, in addition to these 5, is the last one, and that is called the consolidated cash flow analysis. Now, corporate reporting, in the consolidated financial statement, you're going to be doing consolidated cash flow. But then, as part of question 5, we could be asked to perform a consolidated cash flow analysis. So here, we're not going to be preparing the consolidated cash flow. It will be prepared for us, and we need to analyze the cash flow. So when it comes to the ratio analysis, question 4, financial reporting students, question 5, corporate reporting students, these are the alternative styling of questions that the examiner is going to be presenting. So before you walk into the exam hall, you need to expose yourself to questions covering each of these styling, each of these areas. If not, you get to the exam hall, you have studied your ratios, you have chewed baba on some of the ratios and the calculation, but if you are not familiar with the styling of the questions, you're going to walk away from that question with au revoir mon ami, Zokbo. And that is the first thing I want you to understand, the styling of the question. The styling of the question. So one of these waiting for you in the exam hall. That's the first thing I want you to be mindful of as we get into this discussion. And so if these are the styling that the examiner is going to be bringing to us in the exam hall, it is important we understand the underlying principle. As I said, this is our ratio analysis principle guiding document, and we used it. For those of you who are learning under my mentorship, you have access to this document already, and the principle guidelines are available on what you are supposed to do under each of the styling of the questions, the adjustments required, and most importantly, the way you are going to be interpreting the ratios. So we're going to be coming back to some of these things during our executive revision masterclass, but you have this already to give you the blueprint in respect of how you can prepare yourself for the examination. For the last time, before you go into your financial reporting or corporate reporting examination, you have to solve at least one question coming from each of these styling of questions, knowing the adjustment you have to make, and most importantly, how you do the calculation and interpret the ratio. That is going to be important there. The final thing I want to add quickly is corporate reporting students, is the fact that evaluation of the performance of the company is not just about financial performance indicators. Okay? Now we have non-financial performance indicators. So not only are we interested in, profitability of the entity, liquidity of the entity, gearing of the entity, the investors ratios, we are also interested in the non-financial performance indicators, like the social and environmental issues. And so for those ones, the examiner is going to give us the indicators in the exam hall, and so we must know how to interpret them. And the treatment here is pretty simple. For instance, if we are dealing with environmental issues, we can have a freestyle to say that, hey, carbon emission. So when it comes to carbon emission, we can say that 20x5, 20x6. So when it comes to carbon emission, last year, the entity did maybe 160,000 kilograms. Then this year, 20x6, which is the current year, the entity is doing 185,000 kilograms. Stay with me. This is carbon emission, the amount of carbon monoxide or toxic gases that an entity's operation is emitting into the environment. That can come as a result of the production system that the entity is using, which is emitting a lot of toxic gases into the atmosphere, or the distance between where the entity buys its inputs and where the factory is located, or where the entity's factory is located and its final consumers. So if there is a big distance between the factory and final consumers, or where the inputs are and the factory, then there is going to be an increase in carbon emission by the entity. And so the entity must then adopt environmentally friendly way of doing business. For instance, they must find a way to reduce the distance between input and the factory, and find a way to reduce the distance between factory and then what? The final consumers. Because this is very important. Or better still, use an environmentally friendly delivery system or input sourcing system so they can reduce their carbon emission. Now, if you look at this example we have here, 20x5, they did 160,000 kilograms. 20x6, which is the current year, they are doing 185,000 kilograms. So there is an increase in the carbon emission footprint, or the carbon footprint of the entity, 15,000 kilograms. From an environmental perspective, that is not good. It means that the entity's operation in the current year had negative impacts on the environment than in the previous year. Now, this is likely to affect the reputation of the entity, the customer base, or the access of funding to the entity. And so as a recommendation, we may recommend to the entity in our conclusion paragraph that the entity must adopt an environmentally friendly ways of doing business. And that could mean that they may decide to say that they will use renewable energy in their factory, or they may decide that instead of using fuel vehicles for their deliveries, what would they do? They will use robots, they will use drones, they will use electric vehicles and charge those electric vehicles with renewable energy. Then in the future, they can reduce their carbon emission or their carbon footprint. What am I trying to say here? What I'm saying is that in corporate reporting, we are not just going to be dealing with the financial performance indicators. We are going to be dealing with environmental and social issues. And you must understand the implication of the entity's operation on environmental and social issues. Final example, possibly then we can get excited into the question, could be maybe pay ratio. Okay? The pay ratio. So if the pay ratio which means we are looking at a pay ratio between men and women, right? These day and age, women empowerment and those things going on, pay ratio is going to be key. How much does the entity pay its male employees as compared to its female employees? That is very important. So let's say that the pay ratio is maybe 2:1 last year, and this year it is now 3:1. What does that mean? It means in the previous year, male employees earned twice what female employees were earning. But in the current year, male employees are earning 3 times female employees are earning. Again, this is a poor on the part of the entity because it means that the entity is not paying the female staff of the organization like they are paying the male staff. What does that mean in the social environment? It means that people or the organization does not respect or recognize the contribution of women in the entity's operations and the entity's success. That is why the ratio of pay to male and female has even gone up at the expense of women. Now, that would be a poor reputation on the entities at the end of the day, and that could affect funding sources. It could affect the reputation of the entity, and that means this company may not be attractive for women. Because if you're a woman and you come to this company, you are going to be earning, even if you have the same qualification with the man is going to be earning 3 times what you are earning, or you are going to earn 1/3 of what your male counterparts are earning. And that is not a good thing on the part of the organization. And so corporate reporting students, beyond profitability ratios, liquidity ratios, efficiency and working capital ratios, gearing ratios, investors ratios, we must be mindful of the non-financial performance indicators. Please note, the one that the examiner will bring will depend on the context of the question. And so what you need to do as a student is to familiarize yourself with some of the general KPIs, non-financial indicators that organizations use to measure their performance. And you can do that by reading the annual report of companies. So for instance, if you look at financial statements of companies like EcoBank or Scancom PLC, MTN, and some other companies, you will see sustainability reports in their financial statement. They use certain KPIs there to tell their story as to the things that they are doing in the environmental front and the social fronts at the end of the day. And that will help you to have an understanding of some of the KPIs in the non-financial performance indicators that the examiner could ask you about in the exam hall. And when the examiner asks you, you should be able to interpret it the way I have done here when it comes to the evaluation of the financial statements. These are the things that you must understand as the introductory discussions when it comes to evaluation of financial statements. So 2 things. 1, we must know the styling of the question based on the options available. One of them will be there in the exam hall. And then 2, for corporate reporting students, it is important we understand that we will be using both financial performance indicators and non-financial performance indicators to evaluate the financial performance and position of the entity at the end of the day. And these are the things that you must understand. So let's get excited now into our question for the day. Let me get some liquid here before I get goosebumps. So let's go. We are looking at ICAG March 2026 Corporate Reporting Question 5. ICAG March 2026 Corporate Reporting Question 5. That is what we want to use as a guinea pig in our discussion today as we get ourselves excited into this area of our discussion. So ICAG March 2026 Corporate Reporting Question 5. Let's see the requirements we have here. For 7 marks, the examiner says, calculate the following missing ratios for the year ended 30th June 2025. Operating profit margin, okay. Return on capital employed, the examiner said capital employed should be total assets less current liabilities. Because capital employed can be calculated using shareholders fund and then interest-bearing debt. return on parent's equity fund. So it means we are in a consolidated environment here because this is a corporate reporting paper. So we are in a consolidated environment, debt to equity ratio, gearing, and then the last one is the current ratio. And this is for 7 marks. So let's see and go into it. Let's read the preamble. Do we have a preamble? Yeah, we do. Below are the group financial statements of Toji PLC. So let's go. Toji PLC. And the first thing we are calculating is EBAZE operating profit margin. So I, calculation of missing ratios. Operating profit margin for June 2025, right? Got to be careful. 30th June 2025. So operating profit margin. What is the formula for operating profit margin? That is profit before interest and tax. Okay. Before interest and tax. Remember, you got to write the formulas down. Divided by revenue, rev, times, I was going to write 365 times 100 because it should be in percentages. So we need profit before interest and tax. So we go to the statement of financial performance here. So we see statement of comprehensive income for the year ended June. I want you to stay with me carefully. We have 2024, but for now, we're not interested in the 2024 figures. We are interested in 2025. Now, stay with me. We need profit before interest and tax. So you can see there is profit before tax here. But the profit before tax was arrived at after deducting the finance cost, which is the interest. So what we're going to do is to add back the finance cost to the profit before tax, and that will give us the profit before interest and tax. Do you get the idea? So I'm in class, so permit me to just put a note here for you. So PBIT, profit before interest and tax, is going to be profit before tax. Then you add back finance cost. Sounds good? You add back finance cost. So that's how you get PBIT. And so profit before tax is 5825. Then we add back the finance cost, which is 2105. And so profit before interest and tax will now be EBAZE 5825 plus 2105, and that is 7930. Easy peasy. So now we can calculate our ratio. Or maybe I could do something and put this as a workings. Give me a sec. Let me put this as a workings, as part of my workings somewhere. So workings 1, PBIT. So 7930 divided by the revenue. Can you see revenue here? 46,600. Times 100. So let's see what we got. Divided by 46,600 times 100. I'm getting 17, maybe 0.02. How did they leave their answers? Because you know some of the ratios we're giving for the last year, which is 15.987. So they are leaving the answers in 2 decimal places. So we may want to dance like that, leave our answers in 2 decimal places. It was 17.02%. So that is profit before interest. Sorry, that is operating profit margin. The profit before interest and tax divided by revenue times 100. And you know this is looking at the returns we are making after operating expenses and cost of sales are subtracted from revenue. And we expect this ratio to be greater, to be increasing, to be higher, because it could indicate that the entity is generating more revenue and or the entity has better controls over the element of cost of sales as well as operating expenses. And we're going to be coming back to that as we proceed in the discussion. The second one is return on capital employed. So return on capital employed. This is ROSI, return on capital employed. We could still work with PBIT. So give me a sec because I want to tell the examiner on subsequent treatments. If I write PBIT, you should know what I mean by that. Divided by capital employed. Multiplied by 100. So we have PBIT already, which is the 7930. But we need to calculate the capital employed. Remember, the examiner said the capital employed should be total assets less current liabilities. Total assets less current liabilities. So I need you to pay attention carefully here. If we come back here, you can see for the entity, they have their total assets to be 90,510. Then let's look for current liabilities. You know, in this question, the statement of financial position, things were just bundled over. So you have to be mindful to know which one is current, which one is non-current based on the styling and context of the question. And so if we look at it in respect of this, we will say that certainly the convertible debenture is a long-term debt. So the trade payables and accrual will be current liabilities. Right? Trade payables and accrual will be current liabilities. So that is 90,510 minus 8,110. So 90,510 minus 8,110 times 100. So we punch that out to get our answer. We could have worked for the capital employed, but it's not rocket science, so we just jump it up and go away. 7930 over 90,510 minus 8,110 multiplied by 100, and that is 9.62%. So that is return on capital employed. Now, this is looking at the returns that the entity make on the capital available to the entity. Again, we expect this ratio to be higher. But there is something going on here. You could see that the ROSI was 17.02, but return on capital employed is approximately 10. So what is happening? We will come back to that as we look at the analysis aspect. 3 is return on parents' equity fund. Returns on parents' equity fund. Return on parent equity fund. Now, because it is a consolidated environment, so it's still going to be returns on parent. This is like ROI. Right? This is like ROI, returns on parent equity fund. So we're going to be looking at the profit attributable, the profit after tax, profit attributable to equity shareholders, and then we will divide that by the equity of the parent. So profit attributable to equity shareholders. At this point, I need to adjust my slide a little bit. All right, which is the same as parties, divided by the parent equity fund, certainly times 100. So A couple of workings will be required in the context of this question. How do we get a profit attributable to the equity shareholders? You can take the profit for the year. So if we come back to the statement of profit or loss, you can see the profit here. Profit attributable to owners of the parents. Owners of the parents. So we see that coming up. But in the question also, you will see that there is preference shares there. Okay? So you can see here, we have 12% preference shares irredeemable. Now, this is the play here. If the shares are redeemable, normally the assumption is that the interest payments to them would have been brought in the P&L account. So that would have been accounted for as part of the finance cost in arriving at a profit for the year. But if it is irredeemable debt, then the interest or dividend payable to them must be adjusted for in the retained earnings. For that reason, if we want the profit attributable to the parents' owners, it is important we look at the dividend payable to the preference shareholders from that figure. So that is going to be the parents' earnings 3898, profit attributable to the parents 3898 minus the dividend to the preference shareholders. Dividend to the preference shareholders, that will be 12% on the 6,000. Okay? So 0.12 on the 6,000. And that is 720. So the dividend to the shareholders will be deducted here. 720. That is what will give us the profit attributable to the owners of the business, the parents of the business. Very important, okay? Very important. Now, we need to get the parents' equity fund. The parent equity fund. The question we ask ourselves then is, how do we get the parent equity fund? So you go again to your equity segment. Please stay with me carefully here. If you look at your equity segment, we have ordinary shares here. So we bring that up. We see retained earnings. We bring that up. We see other reserves. We bring that up. Non-controlling interest, we don't care about them. So permit me, let me go here. We're going to work for that as workings too in respect of the workflow. So ordinary shareholders. Fund. What am I doing here? Ordinary shareholders fund. So let's bring first the equity shares. How much we got for equity shares? 2,600. Then we bring the second item, retained earning. And that is 30, 140. Then other reserves. That is 2,440. Stay with me. Non-controlling interest is not going to feature, but you see share-based payment. IFRS 2, share-based payment. You know that share-based payment, it means this is going to be like equity share-based payment. But they said see note 2. So let's go to note 2 and see what is in note 2. Stay with me carefully. It says that the share-based payment figure relates to a fully vested share with cash alternative arrangement. So this is a share with cash alternative arrangement. So under IFRS 2, this is where the third party has an option to either take cash or take equity shares. Do you get the idea? Take cash or take equity shares. And so what do we do here? Stay with me carefully. The arrangement gives the counterparty the choice of settlement, but the settlement cannot occur before 30th June 2027. The fair value of the cash alternative at the grant date is 2.6 million. Okay. What is this? If the counterparty has a choice of the settlement, this is a compound financial instrument. In accordance with IAS 32, must be splitted between debt and equity. And so the share-based payment figure you see here, 3,400, is both, it's having both the debt and the equity component. The cash settlement option is the debt. So we have to take that out so that we get the equity component, and that is what we will be adding in arriving at the ordinary shareholders fund. You see the way the examiner is burying IFRS 2 beautifully in the ratios. It means if you don't know that, au revoir mon ami for you, because you're going to walk away with absolutely nothing at the end of the day. So we go here and bring in the share-based payment. Only the equity option. So that's going to be 3,400 minus 2,006, which is the liability component. And that will be what? 3,426. And that's 800. That is the idea about this particular treatment here. Please give me a sec. Okay. So that is the equity component. Then we go back up. Then they say convertible loan notes, trade receivables, we are done for now. So this is going to be the ordinary shareholders fund, the real owners of the business. The ordinary shareholders fund. So arithmetically, what do we have? So I have the 800 plus 2440 plus 3140 plus 2600. And I'm getting 53 980. 53 980. So that is the parent shareholders fund, which we have to use in our workflow. 53 980 times 100. So what do we have here? 3898 minus 720 divided by 53,980 multiply by 100 for us, and that is possibly 6% approximately, because you are getting maybe 5.9%, so 6%. This is the return on parent equity fund. Easy peasy. So the nuance here is knowing that you need to subtract the preference shareholders, their dividend, from the parent's profit attributable to them. Then the second thing is how you treat or you work for the parent ordinary shares. That's the share-based payment. The cash settlement option or form is a liability. So that will not feed into the equity, so it must be taken out. And that is the beauty of the question. And the more questions that you solve, the better your chances of having a deeper understanding of how these things are supposed to be. And that is where our practice question courses will help you. So if you are looking for more questions like this to help you, and we have, for instance, financial reporting and corporate reporting, you can see it here. We have the cost broken down. So under the standards, we have it broken down: single entity, specialized transactions, evaluation of financial statement, consolidated financial statement, everything, carefully selected questions from ICA, ACCA, SEMA, ICAN, various other sources, carefully selected to help you so that you can expose yourself to a lot of questions and see how the principles apply. So you can get access to our practice question courses available on our website and get access to more questions like this. You can download the questions and the solution. Then you can watch the videos explaining the answers and walking you through the solution at the end of the day. Now, remember, your enrollment in our practice question course also gives you the opportunity to be able to join our executive revision masterclass. So for those of you who will be interested, you visit our website and you'll be able to enroll in this, or you can call us on you can call us or send us a message on WhatsApp and you'll be assisted. And we have the courses for financial management, public sector, advanced audit and assurance, management accounting, financial reporting, corporate reporting. And that's the beauty of these practice question courses, to expose you to questions in the various topics covering various areas to enable you so you can go into the exam more equipped with the knowledge required so you can pass the examination at the first attempt. So you want more questions like this, visit our website and complete your enrollment for them. The next thing we are required to do is debt to equity ratio. So debt to equity ratio. Now, debt to equity ratio is going to be a long-term debt, as you know already, or the interest-bearing debt, divided by debt to equity, so total equity here, times 100. So if we go back to the question, can we see long-term debt? Stay with me carefully. Can we see long-term debt? You can see here there is 11% convertible debentures, 16,800. Yeah, that's a long-term debt. That's a long-term debt. Is there any other long-term debt? Yes, the liability components coming in from the share-based payments that we spoke about would have to feed into that workflow. The liability component from the share-based payment will have to feed to that workflow. So if I come here, can I work it? I'm trying to see whether I should work it separately. That's why I'm moving like that. So long-term debt. So we bring in the 11% convertible bond. Which is going to be 16,800. Then we bring in the liability component. Now, we are in 2025, okay? We are in 2025, all right? But then the settlement in the cash-based payments can be done at least 30th June 2027. So that's 2 years from now. So that's why it's part of the long-term debt in respect of that. So we bring that up, the share-based payment. The liability, the cash alternative, if you want, which is the 2,600. That's the idea. Now, you see, this is the play here. There are two schools of thought for this particular workflow we just did. The first school of thought is that under the share-based payment, the cash settlement option is a liability, but on subsequent measurement, it wouldn't be carried at amortized cost. If anything, it will be remeasured at fair value so that any fair value changes will come to the P&L account. That's the flow. So really, we were not going to be seeing interest on this liability, but we are going to be having fair value measurement, and the fair value measurement could result into a fair value gain, meaning the liability has reduced, or fair value loss, meaning the liability has increased based on the value per share of the company at the respective reporting date on subsequent measurement. So we add this up. What do we have? 16,800 plus 26, that is 19,400. And so that is going to give us our long-term debt, 19,400. Now we need total equity. I want you to stay with me carefully here. Total equity. How do we get total equity? Remember, we have currently just the ordinary shareholders fund. That was the figure we had, the ordinary shareholders fund. But we are doing debt to equity. So we need a total equity, not only equity relating to the shareholders, the parents' shareholders. We need all of the equity. So if we need all of the equity, then we need to bring in the non-controlling interest people. Because remember, in consolidated statement of financial position, total equity includes non-controlling interest. All right? So non-controlling interest figure here is 3,020. 3,020. Then the preference shares, because they are irredeemable, they will be under equity, right? So it will form part of the equity. So 12% preference shares. That's 6,000. And so we add these up, and that is what gives us total equity. So at the back of your mind, you have to be mindful of, in the consolidated statement of financial position, how do we get total equity? That's what we are doing here, because we are in a consolidated financial statement environment. And if you don't think about it like that, then you're going to have a lot of au revoir mon amis in respect of how you answer the question. So let's add it up now to get a total equity. 53980 plus 3020 plus 6,000, and that is 63,000 as a total equity. So on the face of the statement of financial position, this is what total equity is supposed to be, 53,000. So we bring that up here, 53,000. So we multiply that by 100 to get our figure coming up for the period under review. 63 rather, not 53. Did I write 50 here? Okay. So 19,400 divided by my answer times 100, and that is 30.8%. Or if you want, 31%. So that is the idea in respect of debt to equity. Debt to equity. Then the last one is current ratio. That's not a miracle, is it? Current ratio. So current ratio equals your current liability. This is assessing the ability of the entity to pay short-term debt. Hey, did I say current liabilities? Your current assets divided by current liability. So this is assessing the ability of the entity to pay its short-term debt as they fall due. All right, its short-term debt as they fall due. So we go back. Now, that's the final one. And you realize that we've been referenced to note 2 already. So if we go into the statement of financial position, we need current assets. Stay with me, stay with me, stay with me. We need current assets. Current asset is made up of EBAZE, inventory, receivable, cash, and bank. Then there is lease receivable here. Ooh. So lessor accounting under IFRS 16. And that is why the examiner says, sorry. That is why the examiner says, see note 1. So before I go to see note 1, let's go to our workings 4, as we try to work for current assets. So I'm going to do my things here. Going to take a screenshot of the 3 guys here. Then we're going to deal with the receivables in the current amount in the receivables from the lease arrangement. So these are the 3. But we are not done, because the lease receivable, again, if you're a good student from IFRS 16, lessor accounting, the lease receivable must be splitted between current and non-current. So the current component of the lease must be included in current assets. Okay? The current component of the lease receivable must be included in current assets. Okay, so let's go read the note 1. On 1st January 2024, which is, remember we are in 2025. So on 1st January 2024, a year ago, Toji entered into a 4.5-year finance lease arrangement with Enum Limited at a 6-monthly rental of 4 million. The rentals are expected to be received in advance at 1st January 2024. Now, if the rentals are going to be received in advance, then the current asset component of the rental receivable will be the total rental receivable less the interest component, or the finance income component. Let's take that again. You know this from IFRS 16. By now, you have done IFRS 16. So if it is received in advance, we're going to bring the annual lease payment, lease receivables, and then we less any interest income. The initial total lease receivable is 22 million. For the purpose of analyzing the lease receivables between current and non-current components at the year end, the following lease table is prepared or is made available. Okay. So we were given the lease table. So you see, they are making the payment, they are receiving the money biannually. So it means every year we have to work for 2 periods. So 2024 has been done already. It is in the previous year financial statement. We see 2025 also coming up. Now you see the figure there under the lease receivable, 2284. Okay, 2284. Now our year ended is 30th June. So 2284. If you are in 30th June, that is why they have that figure as the carrying amount. Give me a sec. That's why they have that figure, this figure, as the carrying amount at the end of the year. But that figure must be split between current and non-current. So how do we get a current component? The current component is simply going to be the annual lease that we are going to be receiving less the interest that we are going to be paying, or we are going to be receiving, which will be in the subsequent year. So the current component of the lease receivable, so let me call it what it is. The current component of the lease receivables is going to be what we're going to be receiving in the next 1 year, which is 4,000 plus 4,000, because biannual. Then we subtract the finance component from that, because remember, every annual lease payment has 2 components in it: the capital element and then the finance element. Now, IFRS 16 prohibits, and accounting in general prohibits, the recognition of future interest income. You've not received it yet, you cannot recognize it. So we need to subtract that from the effect of that, and the effect of that is going to be 1628 So we take that out. So 8,000 minus 1628, and that is 6372. That is how we get the total current assets. So plus 1266 plus 11,100 plus 8870, and that is 27,608. 27,608. So that is our current assets. We can come back to our workflow. 27,608 divided by current liabilities. You remember we used current liability a moment ago somewhere. 8110. And boom, that is what we get as our current ratio. Divided by 8110. Let me confirm the current liability figure, please. Yeah, 8110. That's 3.4 times, or 3.4 is to 1. How did they leave the answer? Okay, so they left the answer in is to. Okay, so 3.40 is to 1. So the entity can pay its short-term debt as they fall due generally. And this is the 7 marks area that the examiner asks you to do. Now, this is 7 marks. So 1.8 times 7, that's 13 minutes. So in 13 minutes, you're supposed to do this, plus the various workings we have done. 13 minutes. 13 minutes. So speed and accuracy is going to be your best friend, as I say always, in the exam hall. If not, you toast it. Now, the II part of the question then says, produce a report. Again, the requirement is to prepare a report. A report. So pro forma is key. By now, you know how to write a report. From subject matter, date, then you have your introduction, then you go. To address the company's board, to assess the financial and social performance of TOSG for the year ended 30th June 2025 relative to the comparative year using the computed ratios in I above, the earnings per share figures, and the human rights measures provided in note 3. Okay. So if you check, we're given a couple of things here. So, as I say always, it'll be important for you to prepare a summary table for your ratios so that everything will be at a glance and you can pick it and boom, work with it. So it's not like statutory, but you want to do that for your own sake. Okay, you want to do that for your own sake. It's not like the examiner will reward you anything, Biama, but it's for your own good. Okay, it's for your own good. So now we have operating profit margin, the first one, which is 17.05. So we bring that up. Oh, give me a sec. So 17.05%. Then we did return on 9.62%. Then returns on the parent, maybe 6%. Then they said we should use the basic earnings per share. So let me bring all these up. I'm going to cancel a number of them. Copy. Paste. So I'm going to try to make sure we fit. right? So in the exam, all you're going to be preparing this, but I'm in class, so you know. So debt to equity, we got 30 point or 31% approximately. Then the last one, current ratio, we got 3.4:1. So the examiner says use what you calculated in I and then the earnings per share figures, okay? And then the human rights. So you are using this to analyze the performance and the social, financial and social performance of the entity. Financial and social performance of the entity. So if we look at it here, operating profit margin is marginally increasing. Return on capital employed is almost the same, although there is a slight increase, is almost the same. Return on the parent equity has also marginally increased. Debt to equity has also marginally increased. It could be almost the same. Current ratio also marginally increasing. So what's going on here? From the financial perspective, then earnings per share also has increased marginally. And so what are some of the things that we can attribute to that? We are seeing revenue going up year on year. Okay, we are seeing revenue going up year on year. And so the operating profit margin marginally increasing could be attributable to the entity generating more revenue in 2025 than they generated in 2024. And that overlaps into the other ratios to give us a positive performance indicator. And you can do this. So you write this out for us. Then the social ratios, see, human rights offenses. Human rights offenses. Own operation. So by the entity's own operation, it has reduced from 7 in 2024 to 5. Human rights offenses, top 10 suppliers. That has increased. So it means the suppliers we buy things from, they are committing a lot of human rights offenses, maybe using child labor in their production. They are not providing favorable working environment. They are not providing favorable working environment for their employees. Okay? And then they may not be paying their employees the appropriate wages due them. All these are forms of what? Human rights offenses. So it then means that the entity is aiding, because if our suppliers are committing this offense, from 25, it has increased to 35, and we are still buying from them. Show me your friend, and I'll show you your future. And so it means we are supporting them to do that. And that is also telling us that is also telling people that as a company, we entertain and encourage our suppliers to continue to do this. Then human rights offenses, top 20 corporate customers, also has increased. So the offenses we commit against customers, meaning maybe infringing on the rights of customers, maybe they require certain things that we don't give them. So from a human rights perspective, apart from the marginal increase in the entity's own internal operation, suppliers and customers, apart from the marginal reduction in their own entity's operation, external stakeholders, customers and suppliers, the entities is aiding and assisting and not performing well on that social front. And that has significant effect on the ESG score of the company and may impact on their reputation, revenue growth, or access to funding going into the future. Looking at the fact that the entity's gearing ratio is just shy of 30%, it means the entity has the potential of raising additional debt finance in the future if they need for capital expansion. Now, if they need additional debt finance, but their social KPIs are not improving, but they are further deteriorating, the entity may find it difficult to get what? Money from especially providers of finance who take social issues seriously and are not really bothered or that much concerned about the financial issues. These are some of the things that we need to understand on the analysis bit. So you see that the non-financial issues here are social issues, and they are just about human rights. And the examiner wants to see how you can use that to interpret the social performance of the entity. These are the things that you must understand in respect of this question. And that report write-up is 8 marks to give us 15% in the corporate reporting environment, usually for evaluation of financial statement of an entity. That's it. We are done. And so again, if you want more questions like this, certainly visit our website, get access to our practice question courses, get access to guided questions like this, solved in a video like this, broken down like this. And then if you have any questions, you can reach out to our support. We are there to help you so you are equipped properly to go into the exam hall, write the exam with confidence, and most importantly, pass the examination. And that is where we are going to be wrapping up our discussion for today. Seidu Seriki said, "Great presentation. I love your delivery." Thank you very much, Seidu Seriki, for your comments. Do we have any other questions from other sources coming up? Okay, I think virtually we're good in respect of that. So that's it about that. And we're going to be wrapping up around here today. And we're going to be continuing with the discussion in the next session. So remember to stay connected, like, share the video, and make sure you subscribe and follow the page if you have not, so that when we go live, you'll be notified to be able to join the discussion. As I say always, please do not sit down 3 days to the exam, 1 hour to the exam before you start doing anything. Put yourself in the position, understand the structure of the syllabus, the way we have done on ratios today, and know the styling of the questions the examiner is going to be bringing. Once you know that, put yourself in the position where you can go to the exam hall and write the exam with confidence and pass. You don't have to write this paper 2 times, 3 times, 4 times. It's not required. You can write this paper in one sitting or in your next sitting, and boom, get everything done at the end of the day. So enjoy the rest of your day, and I'll see you in the next one as we continue with our discussion. Take care of yourself, and I'll catch you on the next one.